So every out now and then I fumble.
That's what you call a silent opening.
A soft opening. So yes. Yes, I am now aware that I was muted the whole time. So
since half the crowd and I all screamed at you.
Wow. You remember when COVID first happened and everybody was going to Zoom, and that was the most common mistake that people would made would be they were either self-muted or they weren't muted.
Right.
And
And
here I
then
am in
the
2023
other
already
problem,
making those same mistakes.
right? And then the other problem was is that they, for some reason, could never find the mute button and the unmute button. They go, "Where is it?" You know, people, everybody's trying to help them, and nobody can find it. And yeah,
Oh, yeah. Our friend Sherry did point that out to me. Thank you, Sherry. Appreciate that. So, Richard, how are you?
well, now that I can hear you, I'm just fine.
Well,
And you,
today,
sir?
just to catch everybody up today, and the opener, what I was just saying is that I recently went to a Note Expo conference. I'm going to be discussing kind of what happened there and what I learned from it. Richard's going to be on obviously today, and he's got a asset that he just bought, a note, and we're going to kind of go over the details on that. And also, we've got some Black Knight Financial Data, who's been bought by ICE now, and we'll kind of give you the Mortgage Monitor update with some interesting things happening there just to keep on top of. And Richard and I will kind of discuss that here. But Richard, let's talk about Note Expo.
All right. Tell me what you, since I was unable to go this year, tell me what you found.
Well, let me just break down what Note Expo is for those of you that don't know what I'm talking about. So there's a few note-only conferences in the U.S. here throughout the year. There's usually about, I would say, probably 4 to 5 of them that are pretty specific to real estate notes in general. And this one for our seller finance community is the largest one, and that's the one where Richard and I know most of the people that go there because we're all in the same kind of community. Richard was not able to go this year. I did go this year. It's in Dallas, Fort Worth, Texas. So the next time that they'll have one will be in 2024 at the first weekend of November. So you can go to noteexpo.com and you can pick up your early bird tickets for that as well. I think they're $300 off if you get them now. Pretty good pricing. Anyways, so you get there and they have like, I'm sorry, what?
I kind of like smote.
Like what?
Like smote. You said you smote something, and you went to the Smote Expo, and I thought, oh, I haven't smote anything in a while.
Putting words together. I'm just my tongue's all twisted today and all tied. So I don't know. I felt like I got great sleep last night too. So I don't know what my issue is, but anyways, I digress. So Richard, I get there. The opening act is a keynote speaker of none other than Mr. Damon West. Damon is a keynote speaker for many different things and events throughout the country. He mainly goes to State Farm agencies and talks about stuff. And his little story, his spiel is Be the Coffee Bean. So he wrote a book. It's a 2-time bestseller on New York Times bestseller list. It's called Be the Coffee Bean. Really cool story. He basically was a really good athlete. He got a football scholarship to go to a D1 school in Texas for being a quarterback. Something happened. Either his arm blew out or his knee blew out or something. And he ended up getting just a regular old job. It was kind of a Wall Street type job. He turned into the drug scene. He, got into meth, and he was a burglar. And so he would go burglar houses and stuff, and he got caught. Went to his indictment, and he basically his jury found him guilty, and they sentenced him to life in prison. And so he got sentenced to a supermax facility in the state of Texas. I think it's the way he described it. It's the highest level one in the United States is the way that he described it, or how I remembered him describing it. And so basically he was able to get out on parole after about 7 years because of like good behavior of being the coffee bean. He explains what that means and kind of all about it, and who kind of taught him on how to be the coffee bean and his interactions in jail and stuff. So it's a really cool, inspirational story. I'm not giving it any thunder like it should have by the way I'm explaining it, but trust me, if you see Damon West or hear about Damon West and Be the Coffee Bean, you definitely should pick up that book. Richard was...
We can get it as an audiobook?
Yeah.
Right?
I did
I
do a
wanted,
Facebook. I did do a social media post too about that, and I tagged him on a lot of those posts, and he did like them. So hey,
well, you've got me interested now. So I'm actually going to download it, and I like audiobooks.
it's kind of cool that that morning that he was giving the keynote was a Friday, and I
Mm,
went down to have breakfast at the hotel conference, and I sat down. I noticed Mr. Bob Repass was there with his wife, and I was like, oh, I'll just sit down with him because there's an empty seat there. And I asked if I could sit down. I'm like, yeah, sure. And I got introduced to this guy. He says, hey, my name is Damon West, and I was like, hey, I'm Justin Bogard, blah blah blah. And we just got to rap, and I was like, oh yeah, you're the keynote speaker today, and I didn't want to know anything about it, so I didn't like ask about it or anything. So I wanted to kind of hear about it for the first time. Kind of like when you see a movie, I don't like to watch the trailers. I just like to see the movie. I feel like the trailer just spoils the whole thing.
mm.
But anyways, that was just kind of cool. We're sitting there talking about just random stuff for like, a good 30, 40 minutes. And then I hear this impactful speech and I was like, oh man, I'm so blown away. So it was really cool to get to know him, shake his hand and hear about his story. So
Sure. It sounds
so
good.
that got our juices going, man. So
Hmm.
that was kind of fun. And then they had a lot of subject matter on non-performing loans and
Hmm.
specifically the commercial space and what these kind of bigger hedge funds that we're connected to, they were at the conference and they were talking about what they see and how there's kind of Richard, what you would call it, like a wedge in the funnel pipeline of non-performers. So that it's just a little bit dripping through here and there, but they really don't see this sustaining much longer for the commercial non-performing stuff. Um, they really think the floodgates are going to open pretty soon with that stuff. So they really think that the retail downtown office space is the stuff that's going to get hit the hardest because of vacancy rates are like 20 to 25% is what they're
Hmm.
seeing in some of these major cities. I don't know what you see in San Francisco. Do you have any data on that, on what it
Well,
is now?
San Francisco is one of the hardest hit large downtown areas in the country.
Yeah,
It's last time I looked, it's got almost a 40% vacancy rate. And
40%.
yeah, and it is weird. The financial district, when you drive around on the weekend, is always
Yeah,
just vacant, like it would be in any other town. But you go down there on Monday through Friday, and it's still vacant. And um, so the problem they're having with it here is that a lot of those buildings cannot be reconfigured. They're large
okay,
floor plates, and it's kind of what do you do with them?
yeah,
Now, what they're also saying though is that they're hoping that the AI boom takes off and the space gets filled again. We'll see.
gotcha.
That remains to be seen.
Well, 40% is a big number.
Hmm.
And it would make me wonder what's going to happen to that stuff because loans get called due. If you guys don't know how commercial loans work, this is kind of Richard's area of expertise. If he's well rounded in the note space, but he definitely is well rounded in the commercial space. And it would seem, Richard, that is it common for a 3, 5, 7, 10-year balloons for commercial loans? They don't really go out further than that.
Yeah, certainly a lot of 10-year notes, and a
Okay.
lot of those are coming due. We've already had, and the trickle down effect is what also is going to hit a lot of people. In that, a lot of the little sandwich shops, a lot of the dry cleaners, a lot of the hotels, two of the major hotels, both of which the names escape me, but they're large national names,
Yeah.
have already filed for bankruptcy and handed the buildings back to the owners.
Wow.
Um, so they're still operating, but they're in chapter right now. So I expect more of that to happen.
Yeah. That's definitely was the consensus there too. So well, we'll be on the lookout for that. I would imagine, Richard, I don't know if it's going to happen like the next quarter, but I would imagine we'll start hearing and seeing stuff in the news, and that's when it's been happening for a minute, right?
Yes, yeah. I mean, and my expectation is that as much of that will get reconfigured as possible. Like especially in New York City, there's such a housing crisis, and
Yeah.
San Francisco. To the degree that they can reconfigure, they will. The other stuff is just going to sit until it gets filled back up, and it may take 5 years.
Yeah, it's quite interesting that what we're in here. So some of the other stuff that they talked about was the affordability factor, which we're going to get into some slides here in a second and show what some of the mortgage data is showing right now for the reports. But Chaz Quinn is Revolve Capital CEO, and he was talking about residential non-performing loans, and he sees a lot of large trades. And when he sees these large trades, he was noticing that he calls them legacy loans, the loans that were delinquent before COVID happened. And he sees a lot of them that the delinquency days have been, their last pay date was like 2016, 2017. So he's seeing a lot of that. So he thinks that there's going to be a good flush of that stuff coming down because the bigger banks don't want to work on, we'll call it remediation or your loss mitigation with the loan. That's stuff that we can do. And so a lot of it, I don't think will make it to foreclosure, but I think a lot of it will be available to go after to work with loss mitigation with those borrowers.
Yeah, I think what's going to be interesting this time in that is that there's a lot of players and actors who are ready to scoop it up to act as middlemen.
Yeah.
Middle players and slice it and dice it up to us.
Yeah.
Us being little guys, we being little guys. Before, when this happened, there weren't. And so the discounts were a lot less. I'm sorry, the discounts were a lot more because there was no middle person. The bank just sold it to anybody who was coming along because they had to get it off their books. Now you've got people like Chaz, who's got a $25 million, $30 million line with PacWest. And so he can take down a whole bunch of that and he'll parse it out. So he'll get a good deal. We'll see decent profits, but maybe not as juicy as we saw last time.
Yeah, I don't think we'll see the discounts like we did. And what we're talking about is, correct me if I'm wrong, Richard, in your opinion, but this was like the 13, 14, 15, 2015, 13, 14 timeframe. You could probably buy non-performing loans pretty regularly for probably 55 cents on the dollar would be the high side, all the way down to, 30 to 35 cents.
Yeah, I would say there was, I looked at some product when I first got started and was too green to jump into it. But
yeah,
I looked at some stuff that was 25 cents on the dollar.
Yeah.
And it was not junk stuff.
And keep in mind though, this was underwater mortgages. So it was
right.
Easier to pay less. Now we have the opposite effect. We have a ton of tappable equity with these non-performing loans, but it makes it even sweeter for the lender because we don't have that risk of buying such a big discount on the UPB. Even if we pay closer to what UPB, unpaid principal balance, sorry, I use acronyms a lot. We could be paying, 60, 70 cents on the dollar of unpaid principal balance, but the house may be worth, another $50,000 to $60,000 more than what the borrower owes on the house anyway. So it's kind of a sweet little deal, nowadays. So when you talk about pricing with non-performers in the legacy versus post-COVID, it's obviously two different ways to do due diligence. I think you and I have beat that up real good on a podcast before a couple times. But.
Yeah, I mean, in general, in those days, you had low equity, high interest rates. Mm-hmm. Now you've got hugely high equity and at least moderate interest rates. Some people would say, well, they're high, but historically they're not high. And if you compare them to the equity, as you said, you're still doing 65% loan to value deal. So come on, how bad can it be?
That's right. All right, let's jump into some slides here so we can show some data points. All right, this broadcast wouldn't be possible without some sponsorships. So as you know, American Note Buyers is one of the sponsors of here, and we have a trade desk. If you email operations@ambfunds.com, we can find some deals for you. If you're looking for some inventory, we have quite a few performing loans. We don't really have any non-performing loans for sale right now. So if you're looking for performing first lien residential, we got you covered. CYREA is our local real estate club here in Indianapolis. Stands for Central Indiana Real Estate Investors Association, and you can reach out to them to become a part of that network. There are many of them that watch this broadcast as well and are part of it. We are a subgroup, air quotes here, subgroup of that REIA. So note investing training, if you're looking to get the know and the foundational knowledge of being a real estate note investor like Richard and myself, you can get some training at with Constant Cash Flow. It's a course that we generated. And if you email info@ambfunds.com, we'll get you the link to sign up for that training course. It's about 25 plus videos, and it gets you from the very elementary levels of understanding of what a note is and kind of different avenues that you can go down for real estate note investing to kind of find your path. I think it's about $400, Richard, for that.
$397.95.
$397.95 and you get
Something
change
like that.
back with a
Yeah,
$400
something like
bill,
that.
right?
That's right.
All right. Our self-directed IRA custodian is New View Trust Company, and they are going to give you they're going to waive a setup fee if you email new accounts at newviewira.com and you mention this broadcast. They're going to waive the setup fee to set up an account. Why would you have a self-directed IRA account? Well, some folks have a 401k from a previous job. You can roll it into another self-directed retirement account with these folks, and then guess what? You can invest in real estate, oil, gas. You can do loans. You can buy notes with it. You can lend Richard money.
Yeah,
Richard likes money.
Mm-hmm.
That's about it. This little slide here is for our Cyria folks. Don't forget that they have a face group. They have an Instagram and a LinkedIn page as well. They do have a pretty robust YouTube channel. You can subscribe to them or follow them. Anybody can. They've got a ton of information on there too. It's a good resource for just real estate in general. I need to take that slide out, that part right there, Richard, because we don't do PHP credits anymore. All right. If you didn't know already, we have a podcast that we do. We're on the 5th season of this podcast. We do about 26 episodes a year. It's anywhere from 20 to 30 minutes long. Richard and I are usually on there most of the time. Sometimes I interview people on there. It's a little banter back and forth and discussion, debate on certain real estate topics that are going on around today. So it's a good listen. So you can download that on any podcast directory that you like. We're on there. We also record the video of it as well and put it on our YouTube channel. For those of you that are on YouTube right now, you can see the different playlists we have, and you can check out all that stuff on our YouTube channel. All right, let's get into some fun stuff here, Richard. I'm going to flip my screen here, so I'm gonna lose you for a second. But this is what we got here. The first slide that caught my attention was this one, Richard, the 30-year mortgage that was rated against the 10-year Treasury bond. So the black line is the 10-year Treasury. That's the value of what the rate is.
Right.
And the blue line is the is kind of what the interest rate is at that time in the graph in the timeline. So if you look all the way to the right, you notice they're looking at basically October of this year. And that gray that's in the background, that's the delta between the two, meaning the more gray filled up vertically, that means that the more the distance is between the black and the blue, which is a spread.
Right. So interesting. I mean, we're all the way close to 8%. For some reason, I don't know why, my mortgage banker that I typically get rates for actually dropped an eighth this last week, which surprised me. But we're still pretty close to 8% nationally, huh?
Yeah, a couple of the notes from this ICE Mortgage Monitor report. So the 10-year Treasury yields averaged more than 4.75% in October, peaking at 4.98% on October 19th, with the spread of the 30-year mortgage interest rates remaining wide at around 280 bips. Composite rate forecasts have risen more than a percentage point in recent months, with October projections calling for 30-year rates to end 2023, this is interesting, at 7.25 and 2024 at 6.4 versus the June projections of what they said we would close at the end of this year at 6.09 and 5.25 at the end of 2024. So that's a huge hurdle from projections from, what was that, Richard, 4 months ago?
Right.
So now saying the end of this year is 7.25, which that makes sense. I can see we're on the path of coming down recently. I think, Richard, it was 7.8 today when I looked.
Sounds about right.
Yeah. And so it looks like we might have a big jump right before the end of the year. And then 2024 will probably start coming down like almost a whole percentage point.
That's what you're saying, what you're prophesying? That
is what the report is saying that the projections are. So I don't know who is making that projection, but the report was just illustrating that, hey, here's the rate forecasts that they see.
Yeah. Well, I mean, we've talked about the sort of the tumultuousness of the market in previous podcasts. We kind of don't need to go over that, but it is interesting. I mean, it's quite often they say, well, the analytics are broken, but they're more than broken at this point. That's possible.
Yeah. Switching to the next one here. So this is the national payment to income ratio, Richard. I know you know this, but for the audience here, we're going to tell you that they're saying the payment ratio is whatever median household income is versus median home price. That's what they're taking into effect. So they're saying right now, as of the end of October, it takes 40.5% of your monthly income to pay for a median priced home on a median priced income. So what
That's
is
amazing.
median price income right now? I don't know what that would be, but I wish I would have got that stat before I put that slide up there so we could know.
Let's see. I'll look it up. How about that?
Yeah. So with the 30-year fixed rates at 7.8%, according to Freddie Mac, now it requires a monthly principal interest payment of $2,567 to purchase the median priced home. This is $144 up from September, and $1,200, which is 94% over the past 2 years. It's gone up.
Okay, so the median income is $74,580 this year.
Wow. So just under $35,000 is the median, is the
amount
what it
that's
would
going
take.
towards the house. Yeah.
Yeah. Whatever the monthly income is. Yeah. That's interesting.
So that exceeds the Fannie and Freddie rate for just payments. Now, I guess we don't really know. No, this is payment to ratio. So this would be just the actual Fannie Freddie rate. It wouldn't be the all-in debt rate, which means that since Fannie and Freddie are both at 34, 35, we're at about 6% higher than what they'll underwrite. That's interesting.
So since it requires that much payment to make the payment on a median price home, it's making housing the least affordable since 1984.
Right. So what that means that the buyers have got to increase their equity to get in.
Well, a lot of things got to happen.
Right.
And I think they get into it here in this report a little bit, and we'll talk about that. So the past 35 years, the payment to income percentage has averaged just under what number do you think?
I'm sorry?
Past 35 years.
Yeah.
What do you think that payment to income percentage has averaged over the last 35 years, excluding this anomaly here?
Looks 4%, 4.5%, something like that.
The payment to income ratio?
Mm-hmm.
No, 25%, just under
25%. No.
No,
I'm sorry. I'm reading the right side of the chart. It should be the left. Yeah, you're right.
Oh.
Right about 25%. Sorry.
Yeah.
Hello.
Yeah, the right axis is the a
interest rate. Yes. Hello.
30-year fixed. Wow, interesting, huh?
Mm-hmm. Very much so.
All right. To get back to long run affordability levels would require some sort of combination of, a 4.5% percentage point decline in the 30-year mortgage rate, or a 62% rise in median household income, or a 38% decline in the median home price value. None of which are likely to happen to fully solve today's challenges alone, and none of which tend to move independently of one another. So that
I'm just going to say, which one do you think is the most likely to happen?
Chicken or the egg?
Yes.
All right. The last slide here I have on this stuff is the median price household income ratio. So all the shaded blue there, as you can tell, when it peaks, that's not good. When it's low, that's good. So you can look at the timeline from 1975, which is actually 3 years before I was born, to 2023. So we got a good amount of data here. So it says that 30-year rates today, at 7.8%, are roughly on par with the 50-year average, which is 7.61. The last time rates were consistently in this range was from 1995 to 2000. So that was, over 25 years ago. During that span, the median home price was 3.6 times the median household income, a ratio that remained fairly steady from the 1970s, 1990s. So they're saying the median home price was 3.6 times what the median household income is. So if it's $70,000, as you say, 70,500. So it's 3.6 times that would be the median priced home. Does that make sense?
Mhm.
Guess
Yes.
what it is? Look what it is now. If you, I don't think my mouse shows up there, but it's almost at 6.
Yeah. Right. Almost.
So 6 times 70,500 would be the median price. That's what they're saying, the median price house. If
Mhm.
if that whatever you looked up is accurate, which we I know you looked it up quickly, so you didn't have time to double check it, but we're
Yeah,
just going to go with
70,
that.
74,580, which actually is a 2.3% drop from 2021.
Yeah. So right at the spike of 2022, that's when it hit the 6-to-1 ratio.
Mhm.
Pretty incredible. You say?
I think so. It's
Yeah.
not boding well for those who are trying to get into the homeownership market.
Yeah. And by the way, if anybody listening to our broadcast here, if you're whatever social media thing that I'm streaming it on here, feel free to make a comment if you want. If you want to say hi and give a shout out from where you're at, we'd love to hear from you too. If you have questions, just any questions, we can pop them up on here and talk about it right now during the presentation, or we might wait till the end and go over a question. But don't be afraid to ask some questions. We're here to help and answer whatever conundrums we need to solve. Right, Richard?
So let's look at a note.
Let's look at your note.
Ah,
Not a note, your note.
that's true.
This is a performing first deed of trust, which is also a mortgage. Same thing, just called a deed of trust in that state, in good old Smithfield, North Carolina. So this is obviously not in a major city, is it?
No, but that area, it's a nice little area. And I can see how a lot of people would like to. This is a pretty big chunk of land. If I remember correctly, it's 5.2 acres or something
Yeah,
like that.
I think it is.
Rather skinny, long and tall, as you can see there.
Yeah, it looks like if you had a building block that was the size of an acre and stacked 6 of them on top of each other, I think that's what this parcel looks like.
That's right. That's right. And there is an easement that access easement that gets you down to the road below, so you can get on. And I don't know what the owners are going to do with this, but in about 3.5 years, they're going to own it outright and have a nice little piece of dirt they can do whatever they want with.
Yeah, they're probably already doing something to it right now. We don't know. So how we came across this is that I come across many deals weekly, daily, and we can't fund all of them. And sometimes we can't fund them all with the company, so we fund them individually. So Richard just happened to take a swing at this with his retirement account because, as if you guys have followed us and listened to us before, he has many partials that have been paying off. So he needs to redeploy his capital. So this was a good opportunity for him just to redeploy some capital. So I showed this to Richard and let him underwrite it and stuff, and we're going to go through all the specifics of the deal. But we didn't say this, but this is a land deal. This is a vacant land deal. And we have to underwrite those with more sensitivity than usual because that's really not our wheelhouse as to if we get the land back, kind of how we sell it and what to do with it. So we do underwrite this one a little bit differently, and we're going to go through that right now. So the property value, Richard, we thought was around $70,000 for this parcel, which is 6 acres. That's not chump change, right?
That's right.
It's a lot. So the note, as we saw it, was a $15,000 down payment. So it was a $66,950 sales price. That means the loan amount is $51,950 because we're really good at math. A 3% interest rate, which I was kind of shocked to see that, but maybe
Especially
this was
on
a
a
friends
land
and
deal.
families
Yeah.
discount.
Right.
It's a pretty low rate. I didn't like that at all, but we can change that. The P&I is $1,000. That's pretty nice. You don't normally see a P&I for $1,000 on a $50,000 mortgage.
Right.
Pretty short term because of that high payment, right? 56 payments from origination.
That's right.
This was originated, Richard, let's see, beginning of 2022, I believe. Okay. All right. So at face value, when you see a note like this, not knowing it's land, what is some give and take on this? Like I kind of went over what I liked about it and didn't like about it. Did you have anything different to add?
Well, I like the loan to value. I wanted to find out a little bit about the borrower's why. In other words, why would they want this piece of dirt that doesn't have really good access? It's got an easement, so they can get to it. It's also got a kind of a crazy shape. I mean, it's a big rectangle, but
Yeah.
it turns out it's very nice forest land. What you can't see from the picture is that it's um, between a Y and the road, meaning that up there where you just had property value,
Yeah.
if you go up the road a little bit further, there's another road that takes off straight across it. So you could really, if they worked it right, they could get access from either road and perhaps do something with it in the future. I don't think this is an area that anybody's going to significantly grow into and put a housing tract, or even though there is one right below there. But it's just a nice little area, and for right now, it's very nice uh, dirt and location. And as you said, they put down a really nice payment, or down payment, and they've been making their payments very steadily. Matter of fact, I think it's even been ACH, so which is something that's always a good sign.
Yeah.
So it seemed like a good deal.
Awesome. All right, let's run through kind of what it is right now. So this is what the loan was created. This is how it was
Mhm.
created. And when Richard and I were pricing this, this is what the current UPB is. So again, unpaid principal balance, meaning how much they have left to pay in principal on the loan. That's what we mean by that. So the numbers in yellow there, they owe 36.8. Still obviously a 3% interest rate. They make $1,000 payment, and now there's 38 payments left. So help me with the math there. Is that 18 payments that they made?
Mhm.
So that's a pretty good seasoning. I like that. 18 payments is a lot.
Sure.
Especially for seeing a land note. Usually we see land notes with very little seasoning at all, like 0 to like 5. But having 18 months is a really nice, and having all the data to show the pay history is really nice too.
Mhm.
So after pricing this and going through this, we got it for 29,600. Well, you got it for 29,700. Let's call it like that, which is a pretty monster rate, almost 17%. We rounded up 17%. Yield there for Richard. So he's getting $1,000 payments. He's getting $38,000 payments. That's
right.
simple.
They're going to go. They will go into my Roth IRA, and I always like things to go into my Roth because I don't have to pay any taxes on it. And so
So
that's a good
typically
thing.
we wouldn't see a residential loan with a high of yield as this one.
Mhm.
And I think that just goes to the risk factor with it. It is vacant land. We don't really know what's going on with it. So if Richard does get it back, it's going to be kind of annoying to resell it. We typically assume we're not going to be able to resell it as fast as a residential home because obviously Richard and I are not experts in vacant land. We do know many people in the business, so we would obviously ask for help. But with that associated risk, we just, this is how you mitigate the risk, right? Is by price.
Right.
So again, risk, we talked about risk. So that is a 42% investment to value ratio, which means Richard's paying, was it 29.7 and it's worth, was it 70,000?
Mhm.
So if he got it back tomorrow, he basically is paid 42 cents on the dollar for this. Does that make sense?
That makes sense.
Perfect. So that's a very good factor. The borrower's LTV, their loan to value, they've paid it down to 55%, which is good from the sales price. So their sales price was 67,000. And so they've already paid it down for this 55% left. So that's pretty good.
Mhm. Mhm.
So it shows a lot of seasoning, which is why the term was so short. It accelerated those payments, accelerated that principal pay down very aggressively.
Right. Right.
So you're making $9,000 in interest alone. And
Mhm.
you're doing it in 38 months. I mean, these are some great factors on this deal to help mitigate some of that risk. And so
Right.
I wish we had 10 more of these lined up for you to buy.
Same here.
Right, you wouldn't be ashamed of that, right?
No.
If you guys have any questions about Richard's land deal, we didn't want to overcomplicate it, so we made it kind of simple and kind of short and sweet. But this is essentially what we did. Obviously, the factors to it is, we got some underwriting done. We checked on all the payments. We verified the pay history. Like you said, Richard, I think they're paying on an ACH. They're pretty much paying like clockwork. So if you think about it, the borrower, see, they paid $15,000 up front to purchase the land. That was out of pocket. And they've made 18 payments on top of that, which is $18,000. So if you do the math there, they've spent $33,000 already on this land. Are they vested?
I think so.
They're heavily vested in this. It's not
I
like they
think so.
spent $2,000 or $3,000 and you're taking a flyer on it. No, they've
No.
spent over $30,000 of their money that they can't get back
Right.
on this property. So
Right.
that's a telltale sign that, hey, they are extremely emotionally and financially invested in this vacant land here. So they're
Right.
doing something with it.
Right. Right. Now, what was so in true disclosure, what was interesting also about this deal is that the seller was very anxious to sell.
Yeah.
And she wanted her money right away. And she didn't want an ACH, she wanted a check. And then when there was kind of these just odd things going on the seller side, which always, makes my antenna go up. Obviously, the mitigating stuff was everything we talked about here, but it wasn't just like we just walked into this deal and said, "Oh, gee, everything is lovely." There's always some hair on just about everything you look at.
So we work with somebody that we know that's the broker in the deal, and they found this deal and they sent it to us, and we had them work with the seller. And I think they came to the conclusion, Richard, that the seller is just an older person.
Mhm.
They're up there. I think that they mentioned that they might be around 80 years old. They just want to spend the money and they're just
Mhm.
anxious to spend it. And I get it. If I was that age and I had some of these assets and I wanted to sell them, I'd be like, yeah, all right, time for me to spend these money on the grandkids, right?
You would go if you were 80 years old and you got this kind of money, you'd go buy a Maserati. I know you.
No, I wouldn't. A used one, maybe a 10-year-old one. I would buy a brand new one.
Maserati. Yeah.
Not falling for that trap.
Okay.
But yeah, so this was a really cool deal, Richard. I'm glad it fell into your lap and you can get it right into your retirement account. It's short and sweet. It's not like it's the 30-year mortgage. You're getting $1,000 a month. You invested, basically, Richard, in 29 and a half months, you've basically made your money back, which is why the math was easy to figure out that, you're getting $9,000 in interest. So,
Mhm.
all right. Well, I don't see any questions on the board about that. So we will just continue on here. So, we do buy land contracts, contract for deeds, note and mortgages, note and deed of trust, lease options. If it's a first lien on residential property, even on land, we would like to take a look at it and buy it. If you scan this QR code, if you want to play back this video and you hover your phone over the QR code, it'll get you to our note quote form. And you can basically enter in the information that we ask you to about the note, and then I'll kind of price it for you within 24 to 48 hours. And we can buy it. So whether you are contracting it, like you are brokering the deal, or you have it in your own portfolio and you want to sell a loan,
That sounds like a good deal to me.
great deal for you. Richard will like to buy more loans. All right, the next
Mm.
broadcast that we're going to do is on Wednesday, December 13th from 6 to 7 p.m. Eastern time. That's about 5 weeks from now. Don't forget to follow us on social media. We got a Facebook page. We've got an X or Twitter account. We've got an Instagram page. You can follow me and Richard both on LinkedIn. You can look up our names on LinkedIn. And if you're interested in our fund, we didn't talk about our fund today, but we do have a real estate fund that we manage as well. It's a $10 million fund. If you're interested in learning more about it, please contact us at investors@ambfunds.com. We're glad to explain to you how our fund works and how you can participate in that. We do have a private Facebook group, and it's called Be the Bank Real Estate Note Investing. If you want to join that group, there's a few hundred people in there. If anybody has questions, we kind of help answer them in that group setting. And we also can put things on for the next broadcast that we do. If you have a specific question or case study, we can go over and beat it up and kind of help you through that deal. So go ahead and stay on the broadcast right now. And we're going to go ahead and transition over to some more Q&A. So hang in there. I always get so hungry after doing these broadcasts. I don't know what it is about talking a lot. I just get hungry. Maybe I use up a lot of energy talking. Do you think that's possible?
Maybe more brain power. More brain power.
What little brain power there is.
We'll have to give you high protein drink so you can just suck them through a straw like that.
That's what I should be doing. I should be putting a protein drink. That's a great idea, Richard.
That's right.
You're not just a pretty face. You have good good things to add. So if anybody has any comments or questions about today's broadcast, please go ahead and chime in there. We'd love to hear from you. Any questions in general about notes? If you have some basic questions, that's okay too. We'd love to answer them for you right now. Richard, based on what you saw today with the reports that I gave, did anything come out as a shocker to you, or did anything was a surprise? Give me your flavor on it.
Yeah, I wouldn't say there's any surprise because we've sort of been in this tumultuous market for a long time now.
Yeah.
And the one thing that would surprise you if things really dropped one way or the next, but I don't think I think automation is going to stay in the market. So I don't see, a lot of salaries going up.
Okay.
There's nothing cataclysmic that we're looking at right now to make housing prices drop. So I kind of expect this to kind of perk along here for a while. I mean, if you look at the job market numbers, people are still buying, and the Fed has been somewhat frustrated with that. There's only so many levers they can pull.
Yeah.
So I think we're going to be steady Eddie at least for certainly through the end of the year here.
What was interesting to me was that little excerpt that the report had on what needs to happen in order for this to be a balanced market. Mm-hmm. And basically the crux of it, and I didn't read too deep in it on live here, but it's going to take a lot of different things, like you said, levers to make this thing a balanced market. And I basically don't see a balanced market for a long time. This could be 5 years.
Yeah, that's sort of what I was meaning. Unless the only thing that would start it is if oil prices really come down. For oil prices to come down, though, Russia's got to pull out of Ukraine.
Yeah.
Saudi's got to come to terms with Russia and their output, and we're nowhere close to that. So.
Well, yeah, the three things they talked about was the interest rate dropping significantly, like 4.5 percentage points. That's huge, 450 bips.
Right.
Okay, that's not going to happen. We pretty much know that, right?
No.
The other thing that has to happen is there has to be a rise in income of 62%. That's not going to happen, right?
That's what I was saying with automation and whatnot. That's just not going to happen.
And then thirdly, what could happen, I guess some factors have to play into it, but the real estate has to drop 30%.
Yeah. And so what would cause that?
What would cause that? I don't know. Countrywide mortgage.
Yeah. I mean, something cataclysmic
Yeah.
would have to happen. And so, I can't imagine what that would be, even if I just can't. It's going to have to be not something that's natural. In other words, if you had a huge earthquake in California and wiped out half the housing stock, that wouldn't do it because it's not nationwide.
Yep.
But
it's kind of. I guess I didn't see this picture happening the way that it did a few years ago when we keep talking about this, but now now I can see this. One thing I think we did get right when we talked about, Richard, was the long tail of non-performing loans dripping through. That we do have a lot of non-performing loans, nothing near like it was in 2008, 9, 10, 11. This is nowhere near that. We still only have 25,000 foreclosures a month when during that time was 250,000 foreclosures a month. Like we're nowhere near that. Right. But there still is several million loans. Well, not several. Let's say 1 million or 2 loans that are delinquent that can be foreclosed on. They're just not going to get all the way to the pipeline. So there's going to be a long, long drip of that. And then with the interest rate staying, I'm sorry, what?
That's a drop in the bucket compared to what we had before.
Yeah. Yeah. Just look, if all the big players are buying those loans, there's not going to be really any for the smaller players anyways.
Right. Right. I mean, you've got all the big Wall Street guys just sitting there, waiting for it to happen. And that's why I say we're not going to see the huge discounts, because everybody's geared up for it to happen this year. And what'll be interesting is that they're going to have to start to deploy their money someplace else.
Yeah.
So some opportunities might come up because of that. But I think the best plays are going to be in your local market.
Yeah.
And they're going to be little pocket things that because you're on top of your market. One happened to me right down the street from my house here. This guy who's 91 years old decided to put his house on the market. And if you look at it, he's had it's an old Victorian. He's made a triplex out of it, and the play will be, even at these new existing prices, to split it up and make an Airbnb. And you can make quite a hefty profit at doing something like that. That's the kind of little very niche-y thing that's very close that I wouldn't have known about if it weren't if I weren't right on top of it in my market.
Yeah. Well, Richard, we are about out of time today.
All right.
So this was kind of fun to beat this up and talk about some of those reports. And thanks for sharing your case study on here. We'll have another case study on the December broadcast as well.
Great.
So let's go ahead and take it away. And thanks everybody for watching the replay. Give us a comment. We'll check it out on the replay stream of this, and we can answer your questions for you. So until next time, we'll see you guys in December.
Okay. Have a good turkey.
You too.
Gobble gobble.